Hello friends, Cristiano Serrato, your real estate agent. Today I'm with Sean Cahan, and today we're going to talk about mortgages. Sean, what are the three biggest mistakes to avoid when getting a mortgage?
Working with somebody that will issue a pre-approval before verifying income or assets. I would say that's the biggest hurdle that what I deal with on a daily basis is I have the opportunity to work with hundreds of real estate agents in the local market here in San Diego. And, individuals will come over and say, well, I didn't have to provide that paperwork to the last loan officer. I didn't have to fill out an application. Well, I do things a little bit different. I require a full application and all of your documentation before I issue a pre-approval because my word is what my word is. My word is gold. When you know that I gave you a pre-approval, you know that you have it. You know that I'm going to stand behind you unless you change something, right? So I would say that the three biggest mistakes are working with somebody that's too quick to issue a pre-approval, working with somebody that is all about interest rate and not telling you the different types of loan programs out there, or trying to get you, everything is based upon an interest rate, which it shouldn't be. And really kind of the third one is that they don't get paired up with someone that they actually like working with. Mm-hmm. I think that's huge. People are always complaining, or a lot of people, oh my gosh, my loan officer, he doesn't get back to me. Oh, my loan officer gave me a high rate. Don't work with him. Find somebody that you like working with. Believe me, you guys are what I always say to every single one of my clients is, I'm very excited that we're in escrow today. You and we're going to be best friends for the next 30 to 45 days. I'm going to call you more than your best friend does. Because I'm going to be there for you. I'm going to let you know the whole process. Because there's really 18 to 21 steps, actually, that a loan goes through. So why am I not telling you everything that's going on? I am your best friend. I'm your best friend for that short period of time.
Great, makes sense. What is a mortgage and how is it different than other types of loans, like credit cards and personal loans?
A mortgage is actually placed against a home, or a residential home. So it's a bank that actually uses the leverage of a house to base the loan off of and then have the individual actually qualify for it. A credit card is more of an open line of credit, and the borrower does no actual property that's actually attached to it. So it's open-ended, so you can borrow against it, you can pay it down. But a mortgage is, typically speaking, is a self-liquidating loan with the start date and an actual end date. So that's mostly the biggest difference between the two.
What are the features and benefits of getting a mortgage?
Well, mortgage, unlike every other type of loan out there, you can actually write it off against your income on your tax return. So the interest and the property taxes are in benefit of the borrower that's actually using it, because you get to write it off against your income to help on your taxes. Also, if you're using it against a rent-to-own version, you actually also have principal to pay down the principal. So you pay the interest, pay the property taxes, and then you also get to write those off, the interest and the taxes, against your income. And during that payment, you're also paying down your principal. It's almost like a reversed 401k, I would say.
Cool.
So it's like me giving you $400,000 today, and then having you pay that off, but actually appreciating based on that $400,000 compared to a loan or 401k. Then you would actually have to put money into it every single time, every single day, every single month, and then it would start compounding from there. So it's kind of like an acceleration of compounding interest.
Great. Yeah. What are some of the different types of mortgages, like ARMs, 30-year fixed, 10-year fixed, and what are the advantages for each?
There's kind of an array of different mortgages out there, but the main and the basic ones are a VA loan for a veteran, and FHA loan is kind of under the umbrella of first-time home buyer, and then also a conventional mortgage as well. Conventional mortgage is a broad spectrum that's, can be a jumbo, or it can be, 10% down, 5% down, 3% down. So conventional is kind of used as a broad terms. FHA is actually insured by the government, VA is insured by the VA, and a conventional mortgage is not insured all the time unless you put down less than 20%. I would say that the ARM product is it's a teaser rate, so it's only fixed for a certain amount of period of time for the actual amortization. So it might be amortized over 30 years, but the fixed actual part of the interest rate might only be 5 years or 7 years, which can create a little bit more controversy in the market with being kind of like subprime.
Cool.
But that's not actually. The subprime market was created from too high of margins, not so much of of a risky arm product per se.
Interesting. So what are the advantages of going through a bank, a broker, direct lender?
Well, there's the three types are like a mortgage bank, which we are. Then there's a broker, and then there's an institutional bank like a Wells Fargo, Chase, or even like a credit union. Here's the major difference is that a broker, you're gonna be sending your paperwork to an individual who package up your loan, who has like an affiliate, relationship with, and then they send your actual file over to, another bank that they chose. And they don't know who the underwriter is. They don't know really like their turn times. They might know their system. They might not know their system. And then they're actually set to a certain comp on the front and also on the back of the loan for like the brokerage and also for the loan officer. There can be issues with that because every bank has their own overlay, has their own, I read this guideline a little bit different because guidelines are actually extremely gray. They're not black and white like what most people think. So just because one bank can't do it does not mean another bank won't actually do like the loan. So that's where it brings up the controversy of, why would I go to a broker compared to a direct bank? A direct bank like ourselves, we're extremely good at kind of narrowing down and saying, well, we don't want overlays. We have the opportunity to sell to different investors after we fund the loan. So sometimes we'll abide by their overlays, but at least like you're only coming to one individual, having one set of underwriters underwrite the loan, having one processing team, one set of doctorars, one set of funders, and then the loan officer really gets to know their own system. So when you go to a direct bank, you can kind of ensure that your process is done a little bit quicker. Like here, we close our loans in less than 21 days pretty consistently for our purchases. Compared to a broker, you might have one day that they might be on a 14-day underwrite, one day might be at a 2-day underwrite. So they're kind of all over the board because they don't have any control over it. Institutional banking, as you know, that's like the most amount of overlays because they have to protect themselves. Also, I'd say like the largest difference is, normally speaking, not on all terms, that the loan officer they have an NMLS license number, but they don't actually have the endorsement. Dodd-Frank actually allowed them to not take the exam, which I think it has like a 65% failure rate. For if you work at an institutional bank or if you work at a credit union, you still have your number, but doesn't mean they actually have their endorsement. So you might not actually be working with a only mortgage professional.
Interesting. Let's talk about mortgage availability. Many of our friends may not think that they can qualify for a loan when in fact they can.
Yeah, I mean, I just did like a seminar about like getting pre-approved. I think a lot of people are afraid of getting pre-approved. They're afraid of getting their credit run. And so what happens there is just go out and do it. Go get your credit run. If you don't think that you're ready, maybe you are ready. Maybe that you found something. There's nothing wrong with getting pre-approved now. And then also maybe, getting a plan intact so that's going to last you like 6 months or 8 months or 9 months. So at least you know the direction. The issue with not getting pre-approved or not going through the process is that you might be doing something that's completely incorrect. You might be trying to focus on credit. Well, maybe your credit's already a 740. A lot of the lending now since like 2014 has kind of gone away from assets and making sure that your credit score is like perfect and more into what's called ATR, the ability to repay. That was a big, huge change in 2014. And so it's really based upon, can you afford this mortgage now? Can you afford this mortgage in the future? Not so much of, hey, what's your credit score? Credit score really only drives an interest rate, MI if you have it, mortgage insurance. Like on an FHA product, you're really going to get the same interest rate if you have a 620 or an 800. So why would you want to spend all of your money on getting your credit up if you have a 680? There might not even be a point of doing that. You want to work with like a loan officer that understands credit, that understands the process of the loan, that understands like the pre-approval of the loan. Running credit today might not negatively impact you in the future. You have a shopping period of 30 days for credit, and you can actually have 10 banks all run your credit within the first 10 days, and that inquiry will only count against you as a one hit. So having multiple people run your credit, or if you're running your credit to see what your score is now, it's not going to negatively impact you, which most of the media says that it will.
Very informative. What are some of the best insights to be able to afford a mortgage?
What you always want to do is you always want to take your gross income and multiply it by 0.43%. That's actually the general rule for what's called QM, qualified mortgage. If you meet that 43%, you're pretty much going to be safe across the board. There are some products like a conventional mortgage to a direct bank. We can actually go up to 45 and even 49% of the debt to income ratio with compensating factors. FHA allows up to 57% back end with a 46% front end. Again, compensating factors. You don't want to get into a situation where you're at 46, 57 and you have no compensating factors, because that is just a road to disaster. But generally speaking, if you look at your gross income, not your net income, and multiply it by 0.43%, you're going to have a general number of what you want your total debt to be or below. So such as if you're making $10,000 a month, you have $4,300 every single month that can go towards your liabilities is a minimum payment. A liability is like a credit card, a car loan, installment, education loan, mortgage debt, rental income, rental debt. So those types of things actually all play a factor. Your cell phone, gas bills, those do not play a factor. That's not considered an installment debt. So what happens is, or any type of liability, so that's not you. So that's why you want to keep it 43% and under, because you also want to realize that, hey, we have to live. We have to, you got to eat. You got to go drive down the street. You got to pay your cell phone. Those types of things we don't really include in the debt to income ratio. So if you're at 57%, I mean, pretty much your whole income's wiped out already. Yeah. So that's why compensating factors is such a big deal.
That makes sense. What types of documents will a person need to provide for a mortgage?
I always use the twos. So on the back of my business card, I always have the 2. Okay. And it's 2 years of tax returns, 2 years of W-2s, 2 pay stubs, and 2 months most recent bank statements or assets.
Okay.
That's kind of like the general rule to get a pre-approval. There's a lot more documentation that goes into it. But if you have those documents readily available, and if you sent that to a lender, they'd be able to give you like a general, pre-approval, or be able to kind of like sniff out a couple other things that they might see on there that might cause complications down the road. So again, it really kind of comes back to, you want to work with a real estate professional or mortgage professional to sniff out those little things, instead of having, I provided these 8 items. The lender didn't look at it or doesn't know how to look at it. I submitted my paperwork. Oh, he didn't tell me that child support goes against my income or my debt to income ratio or something like that. So that's the 8 most common, documentation that I always ask for right up front.
Cool. Sean, walk us through the general process of getting a mortgage.
General process is, working with a realtor to make sure that you do want to go out and purchase a home, kind of have that mind frame. The second is get in touch with like a local lender. I always suggest working with a local lender or someone within state specific, because every single state has a different guideline. So one cannot know all, let me tell you. And the other part is like providing your documentation, being forthgoing with all of your, all of your information. Give them everything. Be diarrhea of the mouth, just, hey, this is my whole situation. Here's my paperwork. Please run my credit. Do an application online. If you're only shopping for an interest rate, you're going the wrong direction. Mm-hmm. Interest rate has such a small factor in actually qualifying for a mortgage. A lot of people in the media is always pushing interest rate. Interest rate, is that the best rate? No closing costs. To be totally honest, means nothing if you can't get a mortgage. Mm-hmm. And so it's really, work with the local lender, work with a local real estate agent in the given area, and then really kind of like give all of your documentation. Go through the actual pre-approval process. Don't fight the actual process of giving the documentation. Don't try to hide anything. Not saying that people try to hide anything, but they conveniently forget about items, and kind of just say it all. Put it out on the line and have the actual loan officer kind of go through the paperwork, massage the paperwork, and try to find like the best program. Once you actually find the best program, then you're pre-approved. You go back and start working with the agent and try to find your house. the best time to shop is at the very beginning. Don't shop other mortgages. Don't shop brokers and institutional banks like after you get into escrow. Do it at the very beginning. Try to find somebody that you actually like working with, not the interest rate. The best person that can give you the best interest rate might be horrible to work with or might not understand your situation. So again, do all of your stuff up front. It'll help you and your agent a lot. And just kind of go through the process, go talk to a couple people, and really kind of get a personality that actually fits. Not so much like, oh my gosh, am I getting the best deal? Because, if you're only looking for like the best deal, yeah, there's some like, go online. You can probably find like the best deal, but their closing ratios are like so slim. It's like 40%, but that's why they can offer the best interest rate, So kind of trying to get away from like, I only want to work with this person because he has an interest rate.
Makes sense. Sean, so each person's situation determines their different options. So tell us some of the different options are for like FICO scores and down payment assistance and stuff.
Down system payment programs are really good. They're actually like city specific. So I would work with that's another advantage of working with a local loan officer to know exactly like in each city what the down system payment programs out there. Like in San Diego, we have quite a few through San Diego Housing Commission and also through what's called CalHAFA. We also have the CH Works, who has like 9 different programs available depending on what city that you're purchasing in. FHA is a really good product for like 3.5% down, 5% down. They have a little bit looser of guidelines. Conventional, they have this new Home Ready program that just got launched not too long ago. And so depending on what area that you're actually purchasing in, there is, income levels. Some are like 0 income levels, and it maxes what's called the LLPA, your loan level pricing adjustment. So if you have like a 680 score and a better, and you're putting down only 5%, you could actually shave like a 0.5% off on this conventional product if your home fits within like the income levels in those areas. So I'd say that those are kind of like the most popular programs right now with the least amount of down payment, because it really does save you on that Home Ready program. It can save you about 0.5% on interest rate if you're buying like a condo, because you don't have your 75 basis point hit for condo. And then also on top of that, your mortgage insurance is the same as if you're buying it with 10% down, but you're only putting down 5 or even 3%. So it's a really cool program.
Makes sense.
Yeah. The other types of programs that are really good are like a VA. That's 100% if you're a veteran. So congratulations, thank you, veterans. You guys deserve it. The other thing is FHA financing, which is a fantastic product for lower FICO scores. I know a lot of people don't bring that up, but it's a non-FICO score driven. You're going to get the same interest rate with a 620 as you do an 800 compared to conventional. Depending on what your FICO score is, the mortgage insurance will be different, the the interest rate will be different. So if you have like high FICOs, go after a conventional low down payment or like a Home Ready, 680 and above. If you have, a little bit more challenged credit, which is not an issue, sometime the FHA will actually yield a lower payment even with the mortgage insurance, because the mortgage insurance is actually set, doesn't matter what your FICO is, and the interest rate is normally fixed as well.
Sean, so what are the different situations that people may be in that may prove to be advantageous for them, like being a veteran, being a first-time home buyer, like that type of thing?
The first-time home buyer is kind of, unless they're going FHA or, FHA is not only for first-time home buying. FHA can also be used for multiple. You just can't leave a departing residence and go purchase another one using FHA without selling this one first if you're within a 100-mile radius. That's actually one of like the newer rules in the 4000.1 guidelines. Being a veteran, that's always an advantage, because I would say that's like the best program on the planet. The loan amounts can go up to $1.5 million, which most people don't realize. Each different county actually has like a different loan limit for VA. Do sellers understand about like the VA? I think that there's a disconnect between buyers and sellers. VA is by far the best loan program. Any seller should take a VA because there's so much flexibility. I mean, the VA does actually want to give back to their veterans at all costs. I mean, they give more guideline changes, more exceptions, more it's almost like a gray book saying, well, is it going to benefit the veteran? Okay, cool, we'll approve it. That's right. And so if you are a veteran, that is something that you would definitely want to go with. The interest rates are the lowest. You have no mortgage insurance. You can do 100% financing up to your county loan limit, or just a small down payment if you go over it. On the flip side of things, not everyone's a veteran, right? So that's why the FHA program is a really, really positive program. That conventional, that home ready is also a really good program. Sometimes seller gets afraid of how much the down payment is because they feel like if someone has more down payment, they can make more adjustments. But that's not always the case. I mean, I have 3% buyers who are more committed than somebody that puts down 50%. So, don't be timid, don't be scared. If you're putting down 3%, hey, work with that local agent. Make sure that your pre-approval is on. Here, I would say about 60% of my pre-approvals actually go out with no loan contingency. So your 3% down is now better than a 50% down because you don't have loan contingency. I make sure that the pre-approval process actually goes through pre-underwriting called a TBD, and you actually have underwriter approval actually before you even go and shop for your home. So
great.
Yeah.
Sean, so what are the 3 biggest things to be aware of when getting a mortgage, like PMI, mortgage insurance, and that type of thing?
I would say the number one biggest thing about getting a mortgage is make sure that you can afford the home. I think a lot of people go outside of the scope of what they're actually pre-approved for, or can convince themselves on getting into a mortgage just because they like the house. Believe me, anything that is brand new is amazing. Doesn't mean that you can afford it. If you're qualified for a $250,000 house, don't go and look at a $350,000 house, because a $350,000 house is obviously going to have more, it's going to be bigger. It's going to have a better kitchen, because that's why it's $100,000 more. I think what happens a lot of the time is that the buyers go out into the market and they start looking at places. Okay, we start at $250, we go to $275, we go to $300, we can't find what we like. Well then, hey, we got to stay with our original $250,000 so that you don't get into financial difficulty. Don't be worried about mortgage insurance. Mortgage insurance is if you don't have 20% down on a single loan, you're going to have mortgage insurance. It can be monthly or it can be built into the interest rate, which if you have high FICO scores, it's better to build it into the interest rate because it will yield a lower total payment called a PHE, or primary housing expense. Prepayment penalties, there's really no prepayment penalties in this market anymore. That kind of went away in 2008 with the subprime market. And even though I don't like to say the subprime market, that was one of they classified as a subprime. Really just kind of focusing on making sure that you can afford the place called the ability to repay the loan. And don't be cash poor. Don't be going over what you actually can afford just because, oh my gosh, I really like that house. Like, grow into it. Use it as a stepping stone. You're not going to find your best house the first time that you go out there, but look at location. Location is a huge problem.
Makes sense. Sean, so there's some things that people may not be aware of, like points and like that thing. Can you explain that?
Yeah, so there's really kind of the terminology that's used in today's market is there's a rebate, which is a lender credit towards your closing costs through an interest rate. There's what's called par pricing, which is kind of like it's as closest to zero. They'll say this is par pricing. That means that it's a zero cost but a zero rebate. And then there's points. I'm not a huge fan of ever paying points because an interest rate is only the note rate if you have it for all 30 years. So if you get into a 30-year fix at 4% and you stay in your house for all 30 years, you're going to pay 4%. But if you make additional payments towards your principal and you bring it down to like a 21-year mortgage, you actually did not pay 4% for your mortgage. It's called your effective interest rate. So paying points is not something that like I'm huge on, and I always talk to my clients about, hey, what's the point of paying points? Because the bank, you're actually kind of just paying the bank right now, right? But we don't want the bank to win. We want to win. We want to be the person that's in control of how much interest that we pay. So what my suggestion is, if you do have the cash to pay for your closing costs and your down payment, get into a par rating. Get into something that's like as closest to zero. And then if you want to change the amount of interest that you pay, make additional payments towards your principal. A, of all, you're paying off your asset faster. B, of all, you're paying less interest. and see if all your house will be paid off sooner. That is the way of actually, I mean, you can change a 4% down to effective interest rate of 3% by really making like 1 or 2 extra payments per year. And you also can change the actual term of the loan from a 30-year mortgage down to like 23 or 22 just by making 1 or 2 extra payments per year. So don't get people get too asphyxiated on interest rate. As I said earlier, interest rate is not the end-all, be-all. I can give you a 3.75 that doesn't cost you any money today, and I can help you change that the actual amount of interest that you pay is 2.75. It's better than paying $15,000 to a bank that's charging for that 2.75%, because now you don't have that money to pay towards your principal. You just paid the bank.
Interesting.
3 best things is to do a full application and a full pre-approval, and give yourself time before you actually go out and start looking for a house. Another mistake that happens a lot is that people jump in. Oh my gosh, I wouldn't found a house. I need to get pre-approved today, and then they're not totally ready. So get pre-approved in advance. That's like number 1. And spill the beans. Air out the dirty laundry. Let everyone know exactly what's going on in your financial life. Provide all the paperwork that is necessary. If you try to fight the amount of paperwork that's actually given, it doesn't do you any good, because the documentation that's required will be required if you give it up front or if you give it at the very end. So it's always better to do it up front. And third of all, work with people that you actually like working with and in the local area. I think that's huge. Your agent and your loan officer should get along very well, and they should, that's why a referral is always probably most likely the best way to go, as long as you actually work with that person as well on the mortgage side. So we obviously know that you like your agent. Make sure that the agent and the loan officer get along, and also the actual individual that's buying.
Sean, thank you so much for taking the time to talk with us about mortgages.
Absolutely.
Friends, obviously there's a lot of elements with mortgages, but you have a lot of options. Of course, for any questions or anything you ever need, we're always here to help. Take care and talk with you soon. Bye-bye.